How does the passive income grind on your small business deduction affect the taxes you pay each year? It can be significant. Let's find out. So first things first, let's understand what the small business deduction is. For any amount of active income below a $500,000 limit after your expenses within your corporation is taxed at a lower rate of 11% in Alberta. Now, once active income gets beyond that $500,000 limit, all of the next corporate earned dollars are taxed at 23%. The small business grind that we refer to means the amount of the lower tax rate that is ground down from things like this, and also these. So how do these sources of passive income we just saw play into this? If your passive income streams in your corp exceed $50,000 of income threshold, a reduction on the amount of income that can be used at that lower 11% tax rate begins. This means that for every dollar of passive income over the $50,000 limit is multiplied by 5, then your small business deduction rate, the $500,000 or less, taxed at 11%, is reduced by that subsequent amount. Sound a little confusing? Let's go through an example. In the first year of your business, you have no passive income, and your corp earns $350,000 of active earned income after your expenses and any write-offs. Therefore, you do not go beyond that $50,000 passive income threshold, and there's no grind to your small business deduction limit. All of the $350,000 you earned as active income in that corp, up to that $500,000 limit, is taxed at that lower 11% rate. A total of $38,500 in corporate tax is payable here. Now, however, in your 5th year of business through dividends, rental income, you have $100,000 in passive income attributed to your corporation. You still earn the same $350,000. $100,000 of passive income minus the $50,000 threshold leaves $50,000 of passive income. Multiply that by 5 and you get $250,000. That $250,000 is subtracted against the $500,000 limit, and you're left with $250,000 of income that can be utilized at the smaller and lower business rate of 11%. However, the other $100,000 of active income you made is taxed at that higher rate of 23% in Alberta. That means $27,500 of tax is payable at the lower 11% rate, and $23,000 of tax is payable at the higher 23% rate. A total of $50,500 compared to the previous example. Now, in your 10th year of business, you have $150,000 in passive income. Again, $150,000 minus the $50,000 is $100,000, multiplied by 5 equals $500,000. This will now grind down all of the available room of your active business income taxed at that lower 11% compared to the higher 23%. So assuming the same $350,000 active business income, all taxed at the highest rate of 23%, is now $80,500 in tax payable. A significant difference, and you can see why the small business deduction is so important to maintain. I hope this info helps you understand the small business tax rates and the deduction a little bit better. If you have any questions or want to see a video on another topic, please comment below. As always, reach out to myself or another CFP professional if you want more advice about how this could affect you. I'll see you next time.